So now we're going to talk about the auditor independence rules. This really becomes important, and I have to say some of the federal funders and oversight agencies were concerned about this because they were seeing some potential conflicts. And one of the problems, particularly in a smaller community, is that there may not be that many CPA firms who really understand nonprofit. You folks are different. The demands on your accountability are different. How you get your money, your objectives, everything else is different. And if there aren't a lot of different firms, or if you have a good relationship with one firm, you might tend to go to them for some services other than the primary audit. But there are rules. When uniform guidance came out, some new rules for auditor independence came out as well. And so that's what I want to address here. So as auditors, as members of the American Institute of CPAs, we have a code of ethics that we need to follow, and a big part of that is about independence. There are other things like planning and supervision, but a big part of it is independence. So we've got our general rules there. But in addition, auditors who perform compliance audits are also governed by the independence rules that are part of governmental auditing standards called the Yellow Book, because it used to be a yellow book. I still have the yellow book in my office here, but it's out of date. So auditors are not independent if they do bookkeeping or make management type decisions about things like what record keeping or payroll processing system to use, or about how to invest retirement plan contributions, things of that nature. They are not independent when they do these types of things. The Yellow Book, again, governmental auditing standards, sections of that list items that will automatically impair our independence. Preparing regular journal entries, authorizing transactions, preparing or changing receipts, purchases, disbursements, or payroll records without management approval. I'm not sure why this one came into play, and it doesn't affect us, but at any rate, certain internal audit services also impair independence. And so you need to be careful of that if you're using your firm to do internal audit service as well as external audit service. On the other side of the coin here, recording transactions that management has approved, preparing financial statements from information your organization has provided, performing audit reconciliations, and recommending adjustments to your financial statements are all permitted. So those are things we can do without impairing our independence. That's why we always give you copies of our proposed adjusting entries. In fact, that's why we call them proposed adjusting entries, because if you don't accept them, then that would make them ours, and that could affect our independence. So those are sort of the specific things we can and can't do, and then we have this process for determining whether anything else impairs our independence. So again, it's the Yellow Book framework to evaluate any non-audit services that aren't specifically prohibited. Auditors need to evaluate threats to independence, apply safeguards to make sure that they are independent, or come to the conclusion that their independence is impaired. Threats could come from self-interest, bias, or familiarity through relationships. The conclusion is that organizations need to be very careful before engaging independent auditors to provide non-audit services, especially when you receive federal funds. So,
John, I just might mention, some of you use an independent bookkeeper or accounting firm to do some portions of your day-to-day accounting. So some of you are having somebody else do your bank reconciliations, for example, and once a month they're reviewing that for you because you are small enough that it's hard for you to do your division your different division of the tasks related to this. It's hard for you to separate those out, that separation of duties. And so you hire a bookkeeper or an accountant to do some of that second look at a number of things that you're doing. If that's the case, that person is not your auditor because they're too involved in the day-to-day to do a financial statement audit with the proper situation here.
This is Ann from West Virginia. That's exactly the situation that we have. But our auditor does do our 990 report. Is that okay?
The 990 report is okay. That's probably a very common thing. Again, it's based on you made all of the management decisions to create the numbers that went into that, to create the policies or other compliance things that we disclose in the 990. So preparation of the 990 generally would be considered to be okay.
And it's appropriate for either role, right? For the contracted bookkeeper or for the auditor to do the 990. Is that right? Yeah. All right. Any other questions about this piece?
That was easy.
That was a short one.